Earnings recap. Tesla, large drawdown, dealing with drawdowns. Market reaction is negative to the Tesla earnings and what that means for us and our portfolio and how we feel about this. This is the Not Even Wrong podcast. It's January 27th, 2022. This is Krim Delco. For the day, the fund is down roughly 10%. The market's still open, but we're sort of in the realm of 10% down. The market's down 1.5%. For the year, we are now down 26.7%. The market's down 8.6%. We're underperforming by 18.1%. Well, the numbers speak for themselves. We have a top to bottom drawdown of like 37%. So meaning the top of the year was the first trading day of the year when Tesla was up 13%, and also our other stocks did pretty well. And then since then, it's just been 35% down from that top. So the drawdown is massive. I've said many times on this podcast that volatility is not just something we try to avoid, but it's part of the business. And this is why I'm talking about this. We can't avoid this type of volatility and we can't trade around it. Let's just put that out of the way right away. If there is technology out there, if there is know-how, if there is consistent know-how that after tax and after inflation and everything delivers better returns over, let's say, a decade, I'm willing to look into it. I'm willing to educate myself. We at Orange Capital Partners don't have that know-how. We don't have that technology to, in a legal way, of course, trade around these events. So what we've decided at Orange Capital Partners to actually even completely disregard volatility in the market. And we now talk about what we call natural volatility and the natural internal rate of return. And those are the things that we focus on. And why don't we just look at the earnings call of Tesla through the lens of the natural Sharpe ratio that we defined a few weeks ago. So let's first talk about the earnings, then introduce the Sharpe ratio again, and then combine the both of them. So the earnings were a stellar, beat on every front. 250 a share, non-GAAP EPS is just stellar given where Tesla was just a year ago. Very solid performance on the cash flow side. The margins are stellar. Automotive gross margins are in the 30s. Just amazing. I mean, everything is spectacular. There's nothing to be concerned about as far as the numbers are concerned. In terms of the outlook, Tesla said something very encouraging. There's three things that Tesla said that I think are important and that have an impact on the stock reaction and also will impact our natural Sharpe ratio. Number one, they said they expect well over 50% growth also this year, which means on top of the sort of almost 90% last year, let's say if we have 70 this year, we could still be in the sort of 80% average growth rate for the last 2 years, which is great given the macro environment, given all the shortages and all that other stuff that's going on in the market. Second, Zach Kirkhorn gave sort of light indication, not guidance, but light indication that the margins are expected to keep expanding, which is also good. That means all the costs associated with inflation, the ramp up of the factories, all these things are still going to be able to be absorbed. And the third, and I think that's the negative part, there was no product update in a sense that they're going to continue to do what they're doing. The Semi and the Cybertruck will not be introduced this year. And in fact, they were focusing a lot more on scaling production of existing products. And this is something I think I want to talk about a little bit, and then I want to jump over to the natural Sharpe ratio because in a nutshell, I think what Tesla is doing is taking away the product roadmap, which is something that technology investors like to see. So that's a negative, but I don't think that's a terrible negative. It's just something people are used to in the tech space. When you cover Apple, so any kind of hardware company, particularly Apple, they always introduce new products. And of course, most of the time, these are not new products. They're just called new products, but in the end, they're just the same old thing with a different wrap and all of that stuff. Tesla is not doing that, and I think that's a good thing. I think it's a great thing that Tesla is not just following the streets wishes to keep ramping and ramping and ramping. So that's a good thing. I think what's even better, and now this is something that I'm very, very excited about myself. Elon Musk is doubling down on AI, and he's doubling down on the flexible manufacturing methods. What does that mean? He's talking about the Tesla robot. But the Tesla robot is really, I think, it's more of an acronym for massive manufacturing at scale in a very flexible way. Now, what does that mean? I think this is where the market is misunderstanding Musk. What Musk wants to do is not just be able to build factories rapidly at scale. He wants to be able to iterate within the production process. This is the key. And I think this is where the Tesla bot comes in. You want to use humans for creative tasks, and you want to use robots for labor tasks. This is, in a nutshell, what Tesla is trying to do. Musk has said many times before that the actual competitive advantage of Tesla will always be the rate of innovation. And rate of innovation is directly correlated with the ability to iterate and the lowering of the cost of error correction. And this is what the Tesla bot should be helping doing. And I think, of course, Musk is not using this language. It would be confusing anyway to Wall Street, but I think this is what Wall Street is not understanding, that manufacturing is not just about building factories. That's something that anybody can do. What Tesla wants to do is to be able to iterate on the existing products at speed, at scale, so that these products can get better and better and continuously drive away from competition. This is, in a nutshell, what the message is in this call. To me, incredibly positive, but it introduces another set of technology risk because, of course, there's a possibility that this doesn't work, that it just simply doesn't work. And that's where the concept of the natural Sharpe ratio comes in now, that I've defined a few weeks ago. It's basically, just to keep it simple, imagine the expected rate of return, and you divide that by your natural volatility minus the cost of, minus the rate of cost decline of error correction. So in other words, you can have a lot of iteration, a lot of try and error, which increases your expected rate of return. But you have a caveat there, which is the more you try and error, the more natural volatility you're going to introduce. In other words, the more mistakes you're going to make, but those mistakes are going to be mitigated if your cost of error correction is lower. So this is, in a nutshell, what we consider the natural Sharpe ratio. And I think Tesla is trying to keep increasing that natural Sharpe ratio because they want to be able to iterate faster and lower the cost of error correction. This is, in a nutshell. They can't necessarily change that the way the amount of errors they make, because they don't really know sometimes what they're actually going to face, the problems and all that stuff. And I'm going to give you a small example of what I mean with that, a very concrete example. Here's the example. So the semi truck is obviously a product that it's a big truck, and the big problem there is, of course, the battery, because you need a lot of power, you need a lot of capacity and all that stuff. Now, what Tesla does, and I know that just to anecdotal information, but it's still real and it's valid information, Tesla is actually trying to develop new types of tires that don't deflate as fast as other tires, because that will save in energy. And this is just a nice example of, you see, when I say try and error, it just doesn't mean that you keep try and error, let's say, on the battery front. You can try on all the other vectors that the product has: tires, design, the battery, of course, all kinds of things that influence the performance and the KPIs of the product. And that's where flexible manufacturing comes in, because if you want to be able to, let's say, change the tires, then you have to have engineers very close to the manufacturing process, understanding how these tires fit into the whole product. And this is also something that Drew Balino said on the call, that they don't really have a research center per se. What they have, though, is they have engineers constantly walking around on the factory floor, trying to understand what's going on, learn from mistakes, and iterate faster. So this is, I think, the big message of this call. I don't think Wall Street understood it. Wall Street basically interpreted this call as, okay, there's no new roadmap, and Musk is talking about this Tesla robot. We don't know what that means, so down 10%. This is roughly where the stock is today, down 10%, 830, something like that. I think another thing, Musk is doubling down on AI. Now, this is, of course, an ongoing technology risk. It's nothing new, but it's still a technology risk in a sense that, is it going to work? Is it not going to work? I've always said that the AI of Tesla is more like Google, where it's not going to be a one day it's going to happen kind of thing. It's just going to be a slow creeping takeover of the driving excellence of humans, and it's going to be delegated to the machines. Very similar to Google. I think in the early days of Google, people still were proudly going to libraries, understanding how to find stuff, and read books and get quotes from books and all that. And then slowly but surely, all this got taken over by Google. And today, you don't really go to the library anymore most of the time. You just get everything you need on Google, let's say, when you do research. So I think it's just going to creep in slowly. And I'm not saying it's going to work or not work, because this is the wrong answer to the wrong question. The question is 5 years from now, the AI of Tesla going to change the way Tesla produces cars and also the way cars are driven? And is it going to be material? And the answer is yes. And it's going to be material for the customer. It's going to be material also for the company. It's going to generate competitive advantage. And those are the kinds of things that we care about most. So these are the main takeaways from the call. And like I said, for us, most importantly, basically every earnings call now, from now on, the way we look at it is the natural Sharpe ratio going to be increased or not? And this earnings call clearly is increasing the natural Sharpe ratio, because we have more try and error on the Tesla robot side and the AI side. And we have, of course, a lowering of the cost of error correction by increasing more flexibility into the manufacturing process. This doesn't mean it's all going to work out and all going to be rosy. But again, the natural Sharpe ratio is a concept. It's not a formula for wealth generation or anything like that. It's a help, it's a tool. So please do your own research. Don't take this as investment advice. This is just the way we think. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. Well, when you run a hedge fund where most of your position is in Tesla and everything you own is basically disruptive innovation, then you better have a concept of what it actually means to be disruptive as an innovator, and how you measure if that disruption is going up or down and all that stuff. And we are very happy to measure that with Tesla and the natural Sharpe ratio. The natural Sharpe ratio is increasing, which means the competitive advantage is going to be widening, and Tesla is going to be a more successful company in the future. Now, as far as the stock reaction is concerned, it's unfortunate, down 10%. So now from the peak, Tesla is down 30%. That is not unheard of for Tesla. It's painful for us, and the way we manage this is through leverage, meaning we focus on our leverage. That's what I mean. This is really the only thing we can do. Make sure that our leverage is such that in a massive drawdown, and we define the massive drawdown as roughly down to about 600, that would be still something that we can stomach. And the answer is yes, we could stomach a drawdown to 600, at least financially. I don't know about our customers and about the emotional reactions of our customers and all that stuff, but at least financially we could stomach a drawdown like that, which is good. And I think at 600, assuming maybe $15 a share for this year for Tesla, it would be, of course, a massive PE contraction. Now, $15 is aggressive. It could be maybe 12, something like that. But still, even at 12, 600, 12, that's 50 times earnings for a company that is growing at least 50%. Probably even more. We believe that is definitely a very good bottom downside that we can live with as investors. To summarize, the earnings call of Tesla has been very positive from our perspective. This is a nice example of when markets and our own perception diverge. This is when money is made. Sometimes it's good, sometimes it's bad. In this case, it's bad, of course, because we are losing money on a mark-to-market basis. But most importantly, Tesla has increased its natural Sharpe ratio by introducing more iteration, more problems that could be solved, and by introducing lowering the cost of error correction by, for example, introducing the concept of the Tesla robot. It might take some time, but most importantly, also the flexibility of manufacturing has been emphasized again, which gives us enough comfort to believe that the cost of error correction is coming down at Tesla, therefore the natural Sharpe ratio is going up. One of the negatives is no product introductions, but we don't think that is necessarily a bad thing, because they still have growth, and that is what's most important. They said that it's because of shortages and stuff. It doesn't matter why they're not introducing the Cybertruck and the Semi right now. What matters is that they keep growing, that margins are expanding, and they're on track to penetrate in their markets where they are and gain market share and transition to sustainable energy, change the way transportation works, and then those products will follow suit for sure. Thank you.